Okay, well, I told you that I was going to probably do the other video another day, but honestly, that last one, the class introduction video, I uploaded it to the cloud, the Zoom's cloud platform, and it still hasn't showed up. So there's a chance I messed something up, but while I wait for it to upload or after I give up, I might have to re-record it, but I just decided I'd record this while I'm waiting. So let me just share my screen and I'm going to talk about financial accounting. Okay. There are all types of different accounting. Okay. So there is tax accounting that's dealing here in the United States, dealing with the IRS. What we have to record is income, what we can record as deductions and things like that. There's auditing, financial statements, auditing financials. That's a different type of accounting. There's accounting that we do for internal decision makers. That'd be like managerial accounting or cost accounting, just trying to figure out what things cost and kind of strategize on what we can sell products for, or what we can provide services for, all that. But what we're focused on in this class, the whole class, our whole focus is on financial accounting. Okay. So financial accounting is accounting that is specifically designed, its sole purpose is to provide information to external users. So people outside of the business. And really it's just two groups. Two like broad groups. Okay. So there are people who are possibly interested in investing in our company. So they want to have some ownership in our company. So that would be investors. We're providing information to investors. And so in this class, oftentimes we talk about, or almost exclusively, we talk about publicly traded companies. Okay. Because those are companies that you can buy shares of stock in, I can buy shares of stock in, we can all buy shares of stock. Okay. So that's the investors. The other group are the creditors or lenders. So that would be like financial institutions. And we provide them information so they can determine if they want to loan us money. Right. So, and that's really, we have two ways to access capital as a business. We can access capital through giving up ownership. And so if you start your own business, you're giving up ownership to yourself, right? So you're putting in money into your business, or you can go out and borrow money from a bank or from someone else. And that's your creditors. Okay. So with accounting, we're not really talking, sorry, let's see if I can, we may just have to do it like this. Sorry, it wants to show up on another screen, but actually, but I could see if this is working. There we go. That's better. It's showing up on all three of my screens, but we're mainly just interested in this one that you guys can see. Okay. So accounting, it's not really counting. Don't think of it as like a math class. The math you'll see is crazy simple. I mean, we're really just doing addition, subtraction, multiplication, division. It's very straightforward, the math, the number side of it. Okay. The part that is way more important is this first part, to account for, or kind of to tell the story. And so what financial accounting is telling a story about the financial condition, the financial operations of a business. And so we're telling a story. So think about even just like your own story, or if your parents are asking about like, hey, what did you do? What did you do last night with your friends? Or how did your semester go? Or, hey, how did that test go? When you tell a story, you're giving an accounting of what happened, right? In the past. And so you're giving that accounting. And so just think about it, like the way that you describe how something happened could be very different than how someone else would describe what would happen. right? Or like, or like all of us know, like sometimes we can embellish certain parts of a story and kind of leave out other parts of the story, um, or different things like that. And so accounting, these rules that we're going to learn throughout this class are really, it's laying the framework and the rules for how a company reports on its story. Okay. And so it's not a math class. It's relevant to anyone and everyone, regardless, honestly, if you're a business major or not. You will do something related to business, even if it's a nonprofit. They do financial accounting, or I mean, anything is going to have a business component. And so to kind of understand how companies, or the rules behind how companies report their financial condition. Okay. So yeah, it's one of those things, even though I just told you like, oh yeah, you guys can do any edition of the textbook, you can go with older editions. Really, accounting is very dynamic. The rules are changing. It's just that the general framework really hasn't changed recently, and so that's why we're okay using those older editions of textbooks. But there are a lot of assumptions made or estimates, and the people who are telling the story, the managers of the business, like they may want to try to manipulate things. So there's kind of this push between the investors and the information that they want to know and what the managers want to provide. So pretty fascinating. Definitely more of a social science, much less of a math class. But the cool thing, a lot of students like the math part of it because it does give you, like, you do get, especially at this stage of accounting, like you do either the answer is right and things balance and it's right, or it's wrong and that you need to do it differently. And so that is kind of nice at this stage. So this is kind of what I was explaining, but it's visual, so it's a little better, right? So we have investors and creditors. They have they have excess capital, right? They have money that they want to invest, and they've got to determine like which companies. There's tons of companies available, right? So do they want to invest in this company or that company? Do they want to loan this company money, or do they want to loan a different company? And so how do they know which companies to invest in? Well, those companies have to provide information. They have to measure their activities, what they're doing, from a financial perspective, day in and day out. They measure those activities, and it's pretty wild, but we can summarize all of their activities in 3 broad areas. So related to the assets of the company, those are the resources that the company has available to it. So that could be cash, that could be machinery, that could be their buildings, stuff like that. Their liabilities, so that's money that we owe, or services that we owe, or basically just financial obligations that we owe to others. And then the difference between those two, so if we have it just as assets minus liabilities, then you have the owner's equity. That's what's left over. That would go back to the owners. Okay. And owner's equity, we'll get into that a little deeper, because really there are 2 ways to increase owner's equity, and there are 2 ways to decrease owner's equity, and that's it. And so we have our financial accountants. They measure the activities of the business, they put it into these broad categories, and then they communicate that information to the investors and creditors. And this is how our economy works. This is why the United States has the most efficient capital markets in the world. Like the gold standard for where a company would like to list itself or trade its stock is on US stock exchanges, because it gives companies the access to the most capital anywhere in the world. Okay. And it also allows companies that have really great products or services to like thrive. Okay, so companies like Apple, they have access to plenty of capital, and so they're able to grow and grow and grow and make more products and services available. Or I mean, recently we're talking more about artificial intelligence companies. So companies like NVIDIA, that provides a lot of the computing power behind artificial intelligence. Because they're a publicly traded company, they have access to huge amounts of capital. And also they're the owners, the shareholders, you and I who own shares of stock in those companies, we benefit as those companies grow. Okay. So if we look at it, net income, and then we compare that to stock price. Okay, so a stock price is at any given time, it's the price of the company as it's traded in the stock exchange. Okay, so like Mark Cuban, I recently read an article on Mark Cuban saying like, yeah, stocks are more like baseball cards. They're just valued at whatever anyone is willing to pay, essentially. And that is true. In the short term, like Warren Buffett will say that a stock is, or the stock market is a voting machine. People can vote the value of a stock to go up, or they can vote the value of the stock to go down in the short term. So it's just based on investors' beliefs, and then value of the company, its profits to its owner. So like, what we believe that will be really going into the future, right? Because the stock price is all about future value, what we think that company will produce in the future. Now, financial information, that is the net income. So in owner's equity, I told you there were two ways to increase owner's equity, two ways to decrease owner's equity. Well, one way to increase it is revenues. Okay. And might as well clarify this right now. So we already, in that accounting equation, we showed assets. Those are the resources of the company, like cash, like money. Okay, so with accrual basis accounting, don't think of revenues like money, okay? Because we're already accounting for that money in that asset category, okay? Instead, think of revenues as the ability to earn, or like the earnings of a company. Or let me think of a better way to explain that. Like revenues for accrual basis of accounting, think of that as, hey, look, there's a cloud recording. So that's good. So it actually did work. So revenues are generated when we provide a good or a service. Okay, so think of it more as like the earning side of it and less of the cash side of it. Okay, it'll make more sense as I show you later on. Probably my next video, I'll explain it better. Okay, and then expenses, those are just the costs that are incurred through the normal course of the business. Okay, as we provide goods and services. Okay, so net income of a company, revenue minus expenses. And ultimately, our businesses, for-profit businesses, the profits are earned for the owners, right? The people who own the business. And this is calculated through the rules that I'll teach you in this class, okay? So the two, net income and stock price, you'll see that in the short term, those may not be correlated very much at all, okay? So there may be a company that people are just crazy about. They love the company, so the stock price is going way up, but maybe they aren't producing income at all. Maybe they're losing money or something like that. But over the long term, what you'll see is that these two things are highly correlated, okay? Businesses who generate income, okay, so they have revenue greater than their expenses, those companies over the long term, their stock price will go up, okay? And so if we look, this is just a quote from this Zacks guy, just saying that earnings trump everything else in terms of importance. You can read through that if you'd like. And then this is just kind of another one, another demonstration of that. So if you invested $1,000 in companies that had their net income was increasing year over year, that $1,000 back in 1997 would turn into $21,827 if you invested that same $1,000 in companies who had their net income decreasing year after year. Then that $1,000 would decrease down to $139. Makes sense, right? Like companies that are long-term profitable, their stock price eventually will go up. Okay. So another interesting thing, like, so here's a company, Toys R Us. I don't know if you guys remember that. You should remember it. Toy chain ultimately went bankrupt, but this chain, there you can see over time their resources, and obviously this is in millions, so their assets declined over time, and their liabilities went down a little bit, but not nearly as much as their assets going down. So ultimately, they had to declare bankruptcy, or another company that declared bankruptcy. So same thing with Toys R Us, like their earnings, their net income also went down over time. And that's ultimately why their assets went down. And then same thing with another company like Sears. Their total assets or resources of the company went down over time, and then ultimately they had to declare bankruptcy. Okay. And then you can compare that to their stock price. Their stock price ultimately went to zero. Okay. Some of the financial statements we'll cover in this class. Income statement, or profit and loss. Some people will call it that, but we just call it the income statement. This has your sales revenue. So remember, think of that as like the concept of earning or providing goods and services. Okay. And then your expenses. So other different types of expenses, store expenses, interest expense, tax expense, stuff like that. Okay. And then your financial statement is a snapshot for the business. Okay. So in one moment of time, it shows the assets, okay, liabilities, and stockholders' equity. So that is your accounting equation, right? And it shows it for that snapshot in time, and you'll see the assets, and we'll go into this in more detail, but your assets will always equal your liabilities and stockholders' equity. See how those numbers make equal each other. Okay. So this idea of financial accounting, it really is, it's huge as far as our economy goes. Even if you don't invest in individual stocks, your retirement accounts are connected to the stock market. And yeah, it's kind of what makes our system work here in the United States. And even if you don't necessarily like the system, if you kind of see some flaws in it or something like that, like ultimately the system that we have, capitalism, it really does drive innovation. The capital in our system, the money that's available in our system will flow to where it will be used most efficiently because of financial accounting, because we provide information to investors and creditors that allows companies to grow and invent more. Those companies who try to provide goods and services that people don't want, or are poor quality, or junk, like those companies ultimately start to decline and go away because people don't want to invest in them anymore. They don't want to buy goods and services from them anymore, and so they stop existing. So and that can take time, and you could say like, yeah, there's corruption, or sometimes companies that you don't like or you don't agree with morally or something, they continue to exist longer than you feel like they should. But bottom line, like over time, this system really does, capital really is allocated to those businesses that the consumers are drawn to, and they're able to grow and everything like that. So now there's a need for some guardrails, and you can argue to what extent there needs to be regulation and all of that. But the more transparent a business is, the better. I think everyone would agree to that. And financial accounting is one way that we make businesses more transparent. Okay, so you can read through these. Some quotes about double entry accounting, and here's a quote from a Nobel Prize winning economist. It really does, in this free market, it allows us to make decisions on how we allocate our resources. This just kind of repeats what I was saying. Yeah, right with all that. So that's kind of the intro to financial accounting, and I'll see you on the next video. Thanks for watching.